Greetings, friends, colleagues, and Communities of Zion's Band Corporation and all of our affiliates. We welcome you to our Fall 2022 Market Update featuring Anthony Valeri, Director of Investment Management for Wealth and Fiduciary Services. Anthony has over 30 years of experience in wealth management and is often quoted in the financial media. We so appreciate you, Anthony, sharing your guidance with us today. I am Peaches Chalenga, and I serve our Treasury customers and colleagues across our organization. And today I'm also privileged to have a front row seat to get to observe our Fall 22 Market Update, serving as your moderator for today's webinar. So Anthony is going to provide a review and an outlook of the economy and the financial markets, share some key investment themes for the remainder of the year, as well as how the midterm elections could impact the stock market. We'll have some time for Q&A at the end of our call, so look forward to that. And with that, Mr. Anthony Valeri, I will hand it over to you.
All right, thank you, Peaches, and thank you everyone for joining our Outlook webinar, our Fall 2022 Market Outlook webinar. On behalf of Zion's Bank Corporation, our affiliate banks, welcome and appreciate the time today. Wanted to give you our thoughts on the economy and financial markets as we look forward to the fourth quarter. Been a tough year and wanted to give you our thoughts as we move forward. So let's get started and first get into the economy. We're going to talk specifically about the labor market to start. This is the JOLTS job opening survey, which we recently had an update. And you can see the sharp drop in job openings down to 10 million. But if you look at this chart over the longer term, still elevated and still a very big number of job openings relative to history. So the Fed will look at this and say its work is not done in terms of cooling the labor market, but the labor market is slowing. You are also seeing that in the monthly jobs report. This is the change in monthly non-farm payrolls. Last week we had the September payrolls with an increase of 263,000. You can see the 6-month rolling moving average, and the labor market is slowing, partly due to response to what the Fed has done in terms of raising rates, but more to go from the Fed's point of view. But it is a common theme that I'll talk about here today. We're not seeing the conditions that would indicate a recession now, but there are signs that the economy is slowing and raises the risk of a recession going forward. So labor is still firm, but on its way to slowing. If you look at the consumer also in pretty good shape. Now, if we look at what's not shown here is consumer spending, total retail sales still hovering around 9% annualized, boosted by inflation, but the consumer is still spending and not indicative of a recession. They're also not over leveraged. This is the household financial obligations ratio. It's put out by the Federal Reserve on a quarterly basis. It measures consumers' debt payments or debt burden relative to their disposable income, and includes things like home mortgage, auto loans, credit cards. And the lower this number, the better consumers are in terms of their financial health. And you can see that it is relatively low to history, nowhere near the levels we saw prior to the bursting of the housing bubble in 2007. So consumers in pretty good shape to withstand a downturn. However, stimulus has been turned off, and high inflation means that consumers are dipping into savings to help fuel consumption, and how much that'll impact the consumer remains to be seen. We'll get another update on retail sales later this week. So evidence that the consumer spending is slowing still remains healthy. Another area to watch that is more of a concern is the buildup in inventories. Here we're looking at the change in inventories as a percentage of the economy measured by GDP. And you can see the last 3 quarters have seen a fairly substantial increase in inventories. Part of this a bounce back due to the supply constraints of the pandemic, but 3 big quarters of inventory growth. And we've seen companies like Walmart and Target who over-ordered trying to anticipate that demand into the future and now cutting prices and having to write down that inventory. So that is a risk as we go forward, could weigh on the economy, as again, these inventories remain elevated. Something to watch, another factor that will continue to slow the economy. And of course, you're aware of record, or the highest inflation rather, since the early 1980s. Inflation likely has peaked. This is the CPI index, and we'll get another release on Thursday, October 14th. The overall rate down to 8.3 after peaking at 9.1%, and the core rate popped up to 6.3 after a brief dip. We do think inflation is in the process of peaking on the overall rate, and we likely see the core rate top out here in coming months and then begin to head lower. But this is still problematic for the Fed, and these rising prices are certainly acting as a brake on the economy going forward. But there are signs inflation has peaked. Commodities, for one, this is the Bloomberg Commodities Index. It is down 18% from its peak and continues to suggest that we've likely seen the top in inflation. So a pretty sharp deceleration in commodity prices across the board, not just energy prices, the commodities, most commodity prices down. And then another way to look at it is tracking money supply growth. It's been said inflation is always and everywhere a monetary phenomenon. It is not the sole driver, but you can see the connection here if we look at M2 money supply growth, a very broad measure of money supply. That's the blue line. You can see the sharp increase in response to the stimulus post the pandemic. But now that stimulus has fallen off, it is decelerated at a very, very sharp pace. And if the historical relationship holds, you'd likely see downward pressure on inflation as measured by CPI. Here we lag the CPI by 18 months, and you can see the relationship. So another factor that's slower money supply growth, and by the way, this is one of the sharpest decelerations in money supply growth in decades as the federal government turns off the spigot in terms of stimulus. So we should see money supply growth exert downward pressure on inflation as well. However, that's not enough as of now to deter the Fed, and unfortunately rising rates and sharply rising rates have continued to put pressure on financial markets. When does the Fed stop? Well, if you look at history as a guide, historically, the Fed has continued to raise the overnight rate until it exceeds the annualized CPI rate. So if you look back here at prior rate hike regimes, and then today the overnight rate is 3.3, or the upper end is 3.25 to be exact. A CPI is 8.3. So there has to be one, how do those two come together? It's either the Fed continuing to raise rates or CPI coming down. I think both will happen, and it'll be interesting to see when that does occur. But the Fed is looking at, historically, if we're looking at a relationship here, this suggests the Fed has more work to do. And a lot of rate hikes if you're just looking at this chart. However, there is light at the end of the tunnel. We can sort of map out what would CPI look like for a variety of increases. So here I take the CPI index that was used on the prior chart and add a variety of growth rates, 0.2, 0.3, 0.4, and 0.5. And it shows what annualized CPI would be under these various growth rates. So at 0.2, you can see the dark blue line. You'll see that CPI decelerates to 2% in June of 2023. And by way of context, the last three CPI prints have been 0.4, 0, and 0.1 on a month-over-month basis. So that 0.2% growth rate is certainly not out of the question. It's that 0.5% growth rate where CPI would only decelerate to 5% in June of 2023. So you can get an idea of what CPI is likely to do with these various growth rates over the coming months. And if the Fed is looking out to where a few rate hikes from now, and they've certainly said they'll raise rates to 4.6% in early 2023, well, then that would put the Fed funds rate above inflation in 3 out of the 4 cases here. Only in that 0.5 or greater case would inflation not be above the Fed funds rate and prevent the Fed from stopping to raise rates. So there is a risk. Does inflation keep going up at that accelerated pace? So far in 2022, it's averaged 0.7, but again, recent months have seen a material slowdown. So it does look like there is some light at the end of the tunnel. CPI set to fall, and that could set the stage for the Fed stopping its interest rate hiking campaign. In the meantime, the yield curve remains inverted. The gray bars represent recession. The yield curve, we define it here as the 10-year Treasury yield minus the 2-year. And when the 2-year is greater than the 10-year, the yield curve is inverted, and that signals a negative spread. And you can see that on the far right. 50 basis points of inversion between the 2-year and the 10-year, getting a very strong signal from the bond market that a recession is coming. We think it's a strong possibility, certainly not a given. Want to caution against using some of these historical measures, and certainly the yield curve has a very good track record of predicting recessions. It's inverted ahead of all of the prior recessions, but in today's economy, there's in markets rather, there's a lot influencing long-term yields, but still 50% or more in our view of a recession over in 2023. And other segments of the markets or the economy that are showing some weakness now, getting back to my theme of slowdown on a number of sectors, residential housing just starting to show the slowdown. This is the S&P CoreLogic Case-Shiller 20 City Composite Price Index. This is through July, and this is a 3-month average, so it's showing data that is significantly lagged. It's still showing a healthy gain up over 15%, but the key point here is that we're seeing a substantial deceleration in some of the more recent data points. August, September, and in early October continue to show a pretty sharp slowdown in housing. Would not be surprised to see residential housing prices be flat or slightly negative year over year in the coming months. Mortgage rates have really hit the brakes on residential housing, and this will be another factor that slows down the economy. Now let's turn to the stock market, and it's been a very, very tough year for investors. If there is one silver lining, it's that valuations are now cheaper than the last 15-year average. Here we're looking at the PE ratio, which is the dark blue line, now falling in the just low 16% range and actually hit just in the high 15% here recently. You can see it's below period average, so a much better valuation for equities. However, the risk is, do those earnings not materialize? And earnings are very important to equities, so that cheaper valuation, will it hold? Well, it'll depend on earnings, and we think the forward estimates are a little too strong. Earnings have been a key driver throughout the pandemic, and lots of folks will point to stimulus, and while that certainly helped, lower rates helped, it's really been about corporate profits exceeding forecasts. And you can see that here. The blue line is the consensus at the start of earnings. The gold is what profits ultimately came in at, and for a number of quarters, 6 quarters, following the pandemic, they beat forecasts and continued to do that in 2022. However, the 5% growth rate for the third quarter, which has actually just been revised down to 4, mostly due to energy. That was the case in the second quarter as well. But do these forecasts materialize? And that really is the risk for the equity market. If they turn negative, we could see some additional weakness in the equity market. I do think those full year estimates on the far right, 8% for 2022 and 8% for 2023, are likely too high. If earnings turn negative, that means more turbulence for the stock market. And we do think that this uncertainty over earnings will continue to create volatility in the stock market. So we're not out of the woods yet. We anticipate a more volatile environment for stocks to continue, even though they've priced in a lot of bad news here regarding the economy and earnings. So this earnings will be a close watch, and we do get earnings kicking off later this week with some of the big financials. And the US dollar has been the most recent factor that will likely weigh on earnings. Over a third of S&P 500 companies derive their earnings from overseas. The strong US dollar is likely to have an impact, and it already has in markets. We've seen turmoil in the British pound. We've seen China intervene to support its currency, as well as Japan. None of those measures have been terribly affected, and the strong US dollar is exerting pressure globally, another factor to keep near-term volatility elevated. But a very, very strong US dollar. You can see here dollar strength using the DXY dollar currency index, strongest since the early 2000s. So a 20-year high in the US dollar, going to add to earnings pressure. And on a longer term view, why is the earnings growth the key focal point? Well, we have a wording here internally that S&P is not GDP. It is about earnings. The S&P 500, you can see the growth here since 1960, and you can also see the growth in earnings. The annualized growth rate in the S&P since 1960 is 7.25%. For earnings, it's 7.1. So you can see the tight relationship. Over short-term periods, they can deviate, but ultimately stocks follow earnings. Over this same period, the economy, as measured by GDP, has grown 3% annualized. So it is all about earnings. We'll continue to track that, and that will determine the near-term course of the equity markets. Again, more to come as we evaluate earnings season. But we do think that slowdown in earnings keep equity markets volatile. And in terms of more specific leadership in the equity markets, we have a bias towards dividend-paying equities and what we call value stocks. You can see this chart shows a strong run of growth relative to value. A rising line means growth, and that includes technology and some of your faster growing companies outperforming value, and a declining line means value outperforming growth, which value reasserted itself late in 2021. A brief in the summer rally of 2022, growth came back, but since then value has reasserted leadership, and we think it likely stays there. We're still recommending a very diversified portfolio with a slightly greater emphasis on dividend-paying equities. And the volatility in the market is a benefit to active management. For years, we've seen passively managed ETFs outperform their actively managed counterparts, with volatility likely to remain high, with the Fed removing its imprint on the market by reducing its bond holdings. We think volatility remains elevated, and that could be a tailwind for active managers. Here we show the S&P 500 with the blue bars, and the red dots represent the percentage of large cap managers outperforming their benchmark. And you can see for a lengthy period of 11 years, active managers lagged the benchmark, but that is changing in 2022. Active management coming back to the fore, 56.6% of managers outperforming their benchmark year to date. So we do see that adding value, and we've made a slight tilt to more actively managed portfolios going forward. Let me turn to the midterm elections real briefly. This is a hot topic, and recently did a communication on that in September. The main takeaway is our mantra: profits over politics. Ultimately, the elections, which are going to be close, we're going to have a very close midterm election the way it's shaping up currently. However, it does look like the Republicans will take the House, and not trying to make a political statement here, but historically, it does not matter who is in what the regime is in Washington for the equity market. The stock market is definitely not partisan. And since 1933, you can see a variety of regimes here. From the far left, a Republican Senate, Democratic House, Republican President. You can see all of those different makeups. And only on the far right, Democratic Congress, Republican President, have we seen below historical average returns. And across the board, pretty strong equity market returns, and consistently strong no matter the makeup of Congress and who's in the White House. So encourage you to remember that. Don't let politics influence your investing view. It's going to be about corporate profits and the economy that ultimately drive the equity market. And I'd be remiss not talking about the volatility in the market here. And just to put this into perspective, the current bear market is fairly advanced relative to history. On this table show all of the bear markets and near bear markets, bear market defined by a decline of 20% or more. You can see the average is down 30. We're down 24 as of today. The recession average is 37. So if we do have a recession, that does imply more downside. And you can see the duration of those bear markets, certainly not as long in a non-recessionary environment. And then the time to recovery on average 2.5 years, with the non-recession average 1.4. If you've come this far with the markets, while another 10% or so down would be quite painful, it's important to put it into perspective on how far the markets have already discounted a lot of bad news. So it could get worse, but just to give you some insight on how far we've come. And then in terms of implied returns to the stock market, just a simple math exercise that I often find helpful when we talk to clients. If the S&P, and this does not include dividends, so the returns would be greater if you included dividends, but if the S&P returned to the prior peak in 1 year, and that's the peak established in early January of this year, it would imply a 31.8% total return. If it happens over 2 years, it's 14.8. 3 years, 9.6, and so on down the line. Even at 5 years, if it took 5 years for the S&P 500 to recoup its record high, that would still average out to a 5.7% annualized return. So some pretty good numbers, and it helps to have that long-term view as an investor. So important to keep that in mind as you review your investment portfolio. And let me turn lastly to bonds. 10-year Treasury yield more than doubled since the start of 2022. Been the worst year for high quality bonds on record year to date, but that added yield will provide benefits on a go forward basis. The 10-year yielding almost 4%. There is some value in bonds. Finally, the 10-year Treasury yield at its highest yield in 10 years, the 2-year back to its highest since 2007. So you're finally seeing some value in the bond market. Bonds will provide better diversification benefits going forward. And for clients looking at their asset allocation, certainly bonds have a little more value here. And part of that is due to the fact that so much in the way of rate hikes is already priced in. The blue bars represent interest rate futures on where the bond market thinks the Fed will raise rates. Currently about 4.6 as a peak in early to the first half of 2023. That's roughly in line with Fed guidance. And you can see the change from late August, just a big change in what the market is expecting from the Fed. That translated to a big jump in government bond yields, corporate yields across the bond market. So an aggressive Fed is largely priced into the bond market, and we think you're getting much better value there. Investors should look at extending duration here over time to take advantage of those higher yields. So much better value in bonds. I think most investors haven't realized just how much. That's still an important part of your asset allocation. And let me pause there. That's all I have for today. I just want to say thank you for joining. And Peaches, I will turn it back over to you.
Thank you for that, Anthony. Fascinating details. I'm thinking of them as they apply to my own life, and that 20-year high of the US dollar, I felt that notable difference in my recent travels. So very cool to see the details around it. We do have a few questions. I think we've got some time. I'm watching the time. A few questions that came in that we'd love to present to you. The first is related to the housing market. Is that all right?
Yes, fire away.
All right. So where do you see housing prices going from here? Do you expect a crash?
I do not expect a crash, and the reason for that is that supply is still very limited. The term seller's strike has been thrown about, and I don't disagree. Over 70%, I believe, of all mortgages are 4% or lower. So it's really going to take some motivation for folks to sell. We're not seeing supply increase, and not just from a seller's standpoint, but there's just not enough housing out there. So I do think that that limit of supply is going to provide some downside protection, and I do not see a crash. I think it's more a case of flat prices to a slight decline year over year. So we will see a slowdown, maybe some weaker prices as well, but not a crash.
Good to hear. Thank you for that. A couple questions related to the economy. Where is the bottom for the economy, and how do we know when we've reached it? Any chance for interest rates to fall?
Yeah, that's a tough question. I get that one a lot. In fact, the matter is we don't know. This third quarter is shaping up to be a good one for growth thanks to stronger exports. I think we'll see GDP close to 3%. Likely see a slowdown again in the fourth quarter to barely positive. And we'll see slow growth throughout the next year. Unfortunately, when it does happen, you don't know for sure, and really hard to predict, impossible to predict when that'll happen. Even the National Bureau of Economic Research, which is the official arbiter of a recession, by the time they declare a recession, it's over by multiple months. And what we like to talk about with clients is that the stock market bottoms before the economic data is at its worst. So if you are an investor, stay disciplined. On average, the stock market bottoms 4 months before the end of a recession. So stay invested. Don't worry about trying to time it. That's impossible to do. We may be seeing the weakest point now in terms of the economy. It may come in 2023, but a lot of that's already factored in to current financial markets pricing.
Thank you. Yeah, I especially appreciate seeing that 5-year that you captured to stay invested and don't let it kind of deter you. Wonderful. Maybe one question on bonds. Should we still use bonds? And if so, what do you recommend in bonds?
I know bonds have been disappointing for their lack of diversification benefits this year, but they still work. And we recommend just staying diversified, use intermediate bonds, start considering longer term maturities. If you did get defensive, you're seeing, again, a lot more value in bonds. These higher yields will benefit in terms of higher returns going forward. So yes, still using bonds in the portfolio, and we think they will provide better diversification benefits going forward.
Wonderful. Thank you for that. And now a few on investing. what's been the most stable investment with the greatest return over the past 25 years?
Wow, Peaches, if I had $1 for every time I was asked that in my career, I'd be a very wealthy man.
You'd be investing it.
That's the unicorn investment. It does not exist. And I get that a lot. And there, as an investor, you just got to make that trade-off. Do you want less risk? Well, the lower return, and you're getting that with bonds, even some short bonds here, offering some very, very nice yields, highest yields in many years. But you don't want to shift all that way, because ultimately, if you're trying to grow capital, stocks is where you want to be, and that's where you're going to have your greatest appreciation over time. So you just have to balance that risk and reward, and certainly what the financial advisor can help you do that, along with some financial planning.
Absolutely. So still in the investment space, if I have cash to invest, should I buy now or wait for additional market declines to take place? When should I put my cash to work?
So the answer is yes, put that to work. Anytime the market's been down 20% or more, that's been a good entry point, and future returns have been stronger, well above average in that case. So I would certainly, tell someone to invest now, put that cash to work. You don't have to do it all at once. If you are concerned about the market, average in over the coming months, but it does pay to take advantage of these cheaper valuations. History's borne that out. So would put that money to work. Don't try to time the market. I don't think people realize when you try to time the market and get out, you have to time it twice, once on the way out and once to get back, and another time to get back in. And that's impossible. Even the most experienced, most successful investors can't do that correctly. So we would certainly avoid that and start putting work to money now.
Yes, thank you for that guidance. All right. Maybe one more. Should I stay invested or get out and go to cash and wait for a better time to invest? Maybe you spoke to that a moment ago.
Yeah, the same timing argument there, Peaches.
Yeah.
That's can't do it. It's you're trying to time it twice. And if you do have a financial plan in place, hopefully you do, and you are looking at the future 3 to 5 years from now, stay invested, write it out, make tweaks as you need to. The only thing we're telling clients is, look, if this really is too much for you, maybe change your asset allocation, but do not go to cash as of yet. Go more conservative if you need to, and be aware of any kind of needs you might have on the immediate horizon. Up to 1 year. If you do need money, then plan for that. But if this isn't needed for the next 3 to 5 years, we'd stick with that diversified investment portfolio.
Wonderful. Thank you for reiterating that. I will ask, do you have any final words for the room?
I just wanted to thank everyone again. Thanks for joining. Do appreciate you taking time out of your day, and we'll look forward to speaking to you again at our full year outlook in early January.
Yes, we're looking forward to that. Well, thank you so much, Anthony, for your remarks and your presentation. We appreciate your timely outlook for Q4 2022. Your insights really allow for us to keep up with market trends and help our clients, our communities, make informed decisions. Thanks also to our production and marketing team for today's event, Vicki Litchfield, Angelia Haig, and Jared Van Leuven for bringing this to us. And on behalf of Zions Bank Corporation and all of our affiliates, we thank all of you for spending this time with us today. We will distribute communication so that you can access the recording of this webinar if you would like to review, perhaps share with other friends or colleagues you have. We'll also provide communication soon about our upcoming webinar in January to really kick off 2023. It's right around the corner. So thanks again, everyone, and have a wonderful rest of your day. Appreciate you being here.
Thank you.